I'm always surprised when I sit down with clients for the first time and I ask them, do they receive the statement of cash flow, which is what I'm showing you on the screen right now. It's one of what we call the three main statements when we're looking at financials: the balance sheet, the income statement, and the statement of cash flows. And what the statement of cash flows does is it really takes those three cash flows that are happening in your business, and it puts them into a numeric form to show what happened during that period of time, whether it's the month or year to date. And so the top part of this statement you'll see is the operating activities. And so it starts with what is our net income? And then what are all of the changes within our working capital, our current assets, if you will, and our current liabilities? In this case, you can see that their receivables went up, so which was a use of cash, meaning that they reported income, but did not collect receivables. Therefore, their cash position went down. So what the statement of cash flows does in the operating is it goes through each of those individual components of current assets and current liabilities and said, did you increase or decrease your cash? And then at the bottom, it will show you what your net cash provided from operating activities. And you can see in this example that they had net income of $99,000 and they generated $96,000 of net cash. So when I would look at that with an owner, I'd say, yeah, that's great. You're managing your balance sheet as well as your income statement, producing cash. The next example is they invested in some computer equipment, and the accumulated depreciation, it's a non-cash asset, so it just gets added back. So in this case, they spent about $1,600 on investing. And then the financing, it looks like the owner took a draw probably to pay taxes or maybe this particular owner was not taking a salary. So when we look then at the three components, we actually, the net cash flow for the period was actually a loss of $27,000. So they used, even though they were generating it from operating activities, and they used a little bit in investing, the financing activities really decreased their cash flow. So when we look at this business, we say, well, they had a negative cash flow for that period of time. When we look at it all together. So while it looked initially like it was going to be positive cash flow because of the operations, in fact, it was not a positive cash flow. It was a negative cash flow. If you are not getting this statement from your accountant, in either internal or external, I would really encourage you to make sure that you start looking at this one and understanding it. It's to me, it's one of the important statements, because as business owners, and having been a business owner, the cash was always where my eye was going, because as I said before, we can run on a loss, but we can't run without cash flow. We got to make sure that we have it. This does a great job, the statement of cash flow, of really showing you where your cash flow is going and what the components of changing it. I will tell you also, as we get into forecasting, understanding this statement too will help you do a better job in your forecasting. So let's talk a little bit the difference between profit and cash flow. I think most of us know that profit is basically our revenues less our expenses, our costs and expenses, and for a period of time that difference makes up profit. Cash, it's what's in our bank at any point in time. That's the difference. I like this example, though, is that revenue, the profit is really an accounting concept. So it's theoretical. I'd heard that the first time I heard that, I had to really think through that. But basically, profit is a concept, and it's an accounting concept where we match revenues and expenses. That's what we do as accountants, is to say, okay, well, I'm not going to recognize the revenue unless I have the associated expenses with it. So we're always looking at how to make that happen. And so it becomes an accounting concept. And as you probably know, if you've worked with your accountants, that number can be changed easily with journal entries by saying, oh, you can't accept that revenue, you can't record that revenue yet because you haven't earned it. I see it a lot in construction companies where the percentage of complete going ahead, and they can't recognize the revenue even though they billed for it. What's in your bank is what we call real. We all know that. That is the basic difference, is that cash is real. That's what we have to spend at any given time. So profit is a concept. It's a theory. It can be I don't want to use the word manipulated, but it can be influenced as to how that gets recorded.